for the 60-minute period to conclude before you make a trade decision, either on an entry or an exit. And therefore, if you have one of these signals, you can then determine whether you want to place an order to get into the market based on one of these patterns and how to place your stop. You may not feel the risk is worth the reward. And if that's the case, maybe you should scale down your position size instead of going all in. If you're a 10-lot trader, scale it down to 4 lots. Therefore, that's one of the things about being flexible. You see a pattern, it's a high probability trade, but the risk may be too great. Scale down your position. Stop close onlys are one of the most fabulous ways of trading in the market. It is an official stop. It's a mental stop close only on an intraday basis. The problem with that type of order is that you, the trader, need to take responsibility, and when the signal says get out, get out. Now, most people don't have that ability yet, so you have to develop it, you have to learn that, you have to get that trait in you, and you can. That's the good news. So stop close onlys on an intraday basis, believe me, they're the most effective stop measurements. If you think about this, a lot of people say, well, John, if I place a stop close only and if the market crashes, golly gee willikers, I'm going to just get annihilated. Well, if you had a stop in there anyway, let's say, if you had a stop right here, do you think you're getting filled here, or do you think you're getting filled on the very low anyway? You're getting filled on the low anyway. So why not wait till the period concludes? If the market bounces all the way back up, the market doesn't close below your low, you're still in the game. So remember, if the risk isn't worth the reward and it is a high probability setup, possibly scale back the amount of contract lot sizes that you're trading in. Failed doji top. One more example. Notice again that the range of the doji will contain the real bodies until we see a close above the doji high, and that's showing you a continuation of the trend and a breakout momentum to the upside. Now, if you bought here on the close or the open, you're in on a euro currency spot Forex, as you can see here. On a spot Forex, you're in on this particular trade at around 128.21, and this is on a 15-minute chart, as you see right here. Look at this, 1, 2, 3, 1 hour later, you're up a small amount, but you're up almost, 22 pips on a trade with no heat, no pressure, nothing to worry about. And then, therefore, as the market really starts to rock and roll, you can then therefore decide whether you want to stay with this trade, scale out of the trade, take partial positions, or move your stop up to break even. My favorite is to scale out of partial positions as we start to demonstrate weakness or loss of momentum. And what's loss of momentum in this trade? Notice the shadows. The market fails to start, it actually stops closing closer to the high, and we see these long shadows. That's not a very good sign if the market's going to remain bullish. So I would probably scale out of half my positions at this point and move my stop to break even on the balance. That way I've generated cash equity in my account, and I'm still able to participate in the trade. And that is following through with a trading plan and a trading program. Now, let's talk about one of the more reliable, highly effective, and probably the single most lucrative pattern that I look for and trade off of on a daily basis. I call it the high close doji. And that stands for HCD, stands for high close doji. I keep things really, really simple. In fact, if pivot point analysis and near pivot supports, we see dojis form more often than not, the key is, why would I look for a morning doji star? Because that particular pattern may not develop, but we may see dojis form. And so therefore, that's how I came to this pattern and identified this pattern over 5 years ago. So in fact, it was around, actually it was a little bit longer than that. It was like 6 years ago, back in 2000. I noticed that the candle patterns, and I saw these pivot points. Now keep in mind, I've been using pivot point analysis for close to 30 years. And so candles really came on the scene with Steve Nissen introducing them to the world back in the early 90s. And so it took time for me to really adjust to following the candle patterns, and they were great. But then I noticed in several markets that we would see dojis at pivots, and it developed into this kind of a bizarre coincidence. And it turned out it wasn't really a coincidence. It just so happens that every time the market was in a downtrend and it came close to pivot support, we'd see a doji, that indecision. It was showing there was a change in the momentum of the market. And then as far as short-term trading, I noticed for momentum shifts, that when the market closed above a doji high, wow, the market would take off. And so therefore,